This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to the chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Ronnie's picture that says, looking for the downloads. Eric, we got to talk crude oil about this breakdown. What are you thinking here?
EIA inventory was delayed by the holiday this week and wasn't available at the time of recording. We'll have that data for you next week. There was a big tumble in oil prices on Wednesday as economic weakness and recession signals abound. But hang on. OPEC Plus is meeting this weekend, and a lot of people have speculated that they're going to smoke the shorts with a surprise cut in production. Now that sets up a move potentially at the futures open on Sunday night. If they do make a surprise production cut announcement, it's almost certain to jerk the market higher, but there's a whole bunch of people, myself included, that are taking long positions in anticipation of that possibility. And, if it doesn't happen, that means everybody is going to be selling into thin liquidity as futures open on Sunday night. So it's very likely that we'll get a gap up or down in one direction or the other on Sunday based on whether or not OPEC makes a surprise production cut announcement. I also want to point out that several analysts, including our own good friend Anas Al-Haji, said months ago that they didn't think the crude oil price recovery was going to happen in the first half of the year when I thought it was going to happen. But they said in the second half of the year it probably would, and they said June is about when they expected things to turn around. Okay, well, it's the 1st of June. Let's see what happens.
Yeah, on page 2, I have the crude oil chart with the 200-day moving average on there. And one of the interesting things was I kept highlighting this kind of $74 to $75 area, which I viewed as the bottom end of the high volume trade range that has been established through the first quarter into the second quarter of the year. And when we broke down below there and then rallied in, technically there's that saying of what was previously support now acts as overhead resistance. The fact that crude oil rejected there just solidifies that the prevailing downtrend is still the path of least resistance. Now, while we may be edging towards where the ultimate bottom will be, and there probably is a key buying opportunity down here, but the way I view it is at the minimum a retest of the previous low and even a shoot down below $60 on a temporary basis are all immediate short-term risks. Ultimately, out of all of this will come a big buying opportunity, but technically, there's no evidence that this is imminent or is going to happen now. So let's continue to see how this plays out as we approach those lower levels. Inevitably, the OPEC Plus could become a catalyst, so that'll be interesting to see whether that does play out that way. Nonetheless, let's get to equities. What are you thinking here, Eric?
I'm still optimistic that a done deal on the debt ceiling is going to bring an excitement rally that takes us up, hopefully to 43.09, because that's my short sell point. But I'm guessing that that's probably going to be the last hurrah for this bear market rally. Obviously, that's pure speculation on my part. I don't know what's going to happen, but that's where I'm placing my bets.
I agree with the idea that we can head up to still make a higher high, but let's first start off with taking a look at the levels. Nick, let's get you in this conversation. And what are the option levels that you're watching here?
Spot price right now is 41.80 on SPX. We have a call wall above at 4,300 and a put wall below at 4,000, which is also heavy support. The implied move for the June 16th OPEX, which also factors in the FOMC meeting, is 110 points in either direction. So the upper expected move is 42.90, just below that key level of 4,300. And the lower expected move is 40.70, just above that key level of 4,000 or so. Key resistance above is 4,200, then 4,300. Key support below is 41.50, 4,100, 40.50, and then a key level of 4,000. Now, looking ahead for the next couple of weeks, we have FOMC in 2 weeks' time, and currently the probability of a 25 basis point hike stands at 34.3%. So about a 1 in 3 chance that we see that hike coming in a couple of weeks. So I expect some volatility to pick up into that OPEX. We've ran pretty hot and on the back of a few key names like NVIDIA, Meta, Google, and Microsoft. So again, I'm still very, very short-term bullish. I think we can tap that 4,300 level, but I don't think we'll have much more gas beyond that.
You know, Nick, what's interesting to me is obviously the debt ceiling resolution has really kind of created a pop and drop earlier in the week. But certainly I was expecting at least a bit more of a reaction bullishly on the news. The window remains quite open for a S&P to rally to 4,300, but really the momentum is lost in the S&P, and it's almost all completely evident in the NASDAQ alone. The S&P 500 equal weight continues to drag to edging lower. Then the Russell continues to be at the bottom in the ranges. You see a very heavy Euro Stock 50 index. Overall, equities outside of the NASDAQ are already very, very heavy. One of the levels to watch, I just put that 50-day moving average on here. I think that any breakdown towards 4,100 would be really the technical advertisement that a short-term high is in. But so long as the pattern of dips are being bought that has literally been dominant since March continues, then we just have to respect that the bulls currently remain on the short term in control. I'll be looking for the transition moment, but it just hasn't appeared yet. But let's move on page 5 to that NASDAQ, because this thing just keeps ripping. Obviously, you're watching some of these key levels. What are the options telling you?
So the spot price right now is 348. The call wall above is at 360, and there's a put wall below at 350 or so. We have a implied move right now of plus minus 12 points for the June 16th OPEX. So the upper expected move is 360, and the lower expected move is 336. Key resistance is just above at 350, then 355, then 370, and key support below is at 335. And again, given that we've ran pretty hot on the back of a few key names, I do think that a pullback is warranted, especially once those names cool off. NVIDIA in particular strikes me as a pullback candidate, given how hot it's ran. It's gone from about $170 to $400 in less than half a year. And the fundamentals don't really support that. Raised guidance, in my mind, does not support a valuation where they're trading at a PE right now of 200 or so. I don't see that as being feasible in the longer term. And I do think the AI hype train has kind of left the station, and it might leave a lot of bag holders, kind of like we saw with the crypto boom a couple of years back as well.
Yeah, I have to agree. But the one thing is that sometimes when this kind of momentum and flow is coming in there, trying to rock star where the actual high is going to come in is always tricky. While I generally think that this is going to lead to some sort of blow off that leads to a pretty deep mean reversion, sometimes you don't want to get in its way. And there's still, I think, room for the market to squeeze out shorts that are too ambitious too early. But certainly, this is a very customary bubblish chart that ultimately will deeply mean revert when the momentum runs out. Nonetheless, I want to move on to page 6 where we got the volatility index, and clearly volatility is very benign at the bottom end of the ranges, and that volatility premium is not being grabbed at very much in terms of hedging out any downside risks. What are you thinking here?
Well, we've seen the VIX tap 20 a couple of times in the past few weeks and bounce right back off of that level, go back to about 17 or so. So it seems that volatility is remaining suppressed in the short term. Once we get more clarity on the debt ceiling crisis and FOMC in a couple of weeks, it's possible that we see a nice big move in either direction, either up, in which case we would see the VIX decline down to around 15 or so, or perhaps a pullback toward that 4,000 level, in which case we probably see a pop in the VIX to around 22 to 25 or so. Again, I don't put as much weight in the VIX anymore as I did previously in years past because of the proliferation of the 0DTE options, which are taking a lot of liquidity from the average 30-day DTEs, which the VIX is predicated upon, and moving them to the 0DTE instead. Now, moving on to the US dollar index on page 7, what are you guys thinking here?
Well, we've been steadily climbing up towards that key resistance at 105 on the Dixie. Actually, 105.5 where it topped out on the last cycle. So for now, we're still just consolidating. But the time has come to watch this market closely for what happens when the Dixie gets to 105 or particularly 105.5. The action there is what's going to bring the next leg.
Yeah, Eric, overall, my theme over the last several months has been that the dollar will be far more trade range bound than it would be downtrending. And that has really materialized. But my view here is that the dollar could actually have a bullish upside break, but it will only come on the back of a real kind of risk-off impulse. I still think the dollar will play its typical role of strengthening in a period where everyone is getting out of most risk assets. And so, will that start here? Let's say on the jobs numbers, or will it still be a month or two away? Maybe the July earnings or something like this. We are likely to remain in this trade range bound, and resistance will be there until I think something breaks. And when we really see the stock market at some point go through a deeper correction is where I would look a little bit more bullishly at this.
Now, guys, moving on to page 8, we have the chart of the gold futures. What are your thoughts here?
Obviously, we already talked about the fundamentals for gold since that was the topic of our feature interview with Ronnie. So I'm going to focus on a technical anomaly in the gold futures term structure that most non-professional futures traders probably won't be aware of, and I think is very relevant to the chart right now. If you look at the continuous futures chart, which almost everyone uses to quote the price of gold, it looks like gold held that critical 100-day moving average support and turned back up quite sharply. That continuous contract futures chart is really looking great right now, with gold having already navigated back above the short-term moving averages and giving the impression that the bottom is in and we're headed back up toward new all-time highs. What's not so obvious is that almost all charting programs will have rolled from the June delivery contract to the August delivery contract this week. Now, for the last few years, it was safe to just ignore these contract rolls. The price for the new contract is generally higher for these rolls than the expiring contract. We call that phenomena contango. Interest rates play a huge role in determining contango, and since interest rates have basically been zero for the last 5 years, it was easy to get complacent and just forget completely about the effects of contango in the continuous futures chart. After all, the price difference was only $1 or $2. But now interest rates are back, and so is contango in the gold market. The August contract is trading at a premium of almost $20 over the June contract. And because the contract roll happened just as the June contract hit that 100-day moving average, it makes the chart look like gold is already $40 higher than where it bottomed. That's an illusion. At the time of this recording, it was only $20 higher than where it bottomed, even though the price on the chart is $40 higher. It's because of the contango differential due to the contract roll. So my point is, don't get too excited quite yet about what looks on the continuation chart like a robust recovery. If you take a look at the August contract chart only, you'll see that it paints a slightly less bullish picture. We're still holding the line on that key support. We haven't moved below it yet, but we're not out of the woods either. And as Ronnie said in the feature interview, another $100 of downside is still entirely possible from here, and if it happens, it doesn't invalidate the bull case. It's just part of the way markets work.
You know, I find it really interesting, Eric, that gold, this pullback, actually mirrors very similar to the pullback we had in February. It just poked down to a 50% retracement, just temporarily below its 50-day moving average. And when this happened back in March, it started a new bullish breakout move on the upside. Now, rarely do things happen exactly the same, so I'm not trying to use that analog. But what will be really interesting to see is what the bulls have here. I mean, if we see that the bulls can, let's say, clear 2,000 with some momentum, maybe what will happen if they go for a double top retest of the highs, or is there enough fuel for them to go and even break gold to higher highs in the sequence? Will tell a lot. If we see that the bulls here are struggling to hold on to gains above the 2,000 level and then it rolls right back down, then that could really start that kind of a bigger correction that Ronnie was even mentioning inside the interview. And so I think that watching how the gold traders play it out this week is actually going to give us a lot of, or at least in the upcoming week, will give us a lot of insights as to what's next here, at least on a short-term basis. Nonetheless, I wanted to wrap up by just looking at the Bloomberg Commodity Index. I'm looking at it through the ETN with symbol DJP. And what I wanted to simply highlight is that while we mess around looking at these charts on individual commodities, there is no denying that the commodity index has been in a decisive bear downtrend for now an entire year. It was June of last year that it put in its peak, and we've seen since then a very decisive downtrend, very clear lower highs, lower lows, and a perpetual downwards channel. The question, of course, is when does this downward channel finally come to an end? The interesting part is that I don't necessarily think this will end with a V bottom, and therefore we might even be going through a prolonged bottoming formation along the downside, even when the ultimate low is put in. We may not be seeing a major turn in this commodity index until the fourth quarter of the year even. When we do, I think it will be an extraordinary buying opportunity. But right now, just this chart continues to demonstrate such distinct weakness, and patience is what's needed here at this level.
Folks, if you enjoy Patrick's chart decks every week here on MacroVoices, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.